7 questions 50% CFA Level 1 candidates fail to grasp, including 3 crucial ones at the end. Question 7. Analytical tools and techniques. A financial analyst is building a model to project a company's capital requirements. She develops a base case forecast and then creates several alternative projections, each based on a distinct, internally consistent set of assumptions describing a different economic environment, such as a recession or a period of high growth. This analytical approach is best described as a sensitivity analysis, B. Simulation analysis, C. Scenario analysis. Correct answer, C. Scenario analysis is like building a few different stories about what the future could look like, each with its own set of assumptions, like a recession, a booming economy, or a steady one. Each story gives you a detailed picture of how things might change, so you can see how important things like how much money you need to invest would change depending on what happens. It's more about thinking about what's likely and what makes sense, rather than just looking at numbers changing. For example, you might be planning for the best thing to happen, a lot of growth, the most likely thing, moderate growth, and the worst thing that could happen, a recession. A. Incorrect. Sensitivity analysis is like a detective story for your business, where you figure out how small changes in one thing, like how much you sell or how much it costs to borrow money, can shake things up for another thing, like how much money you need. You keep everything else the same to see what happens. The big difference is that instead of imagining all sorts of different futures, you're just checking how one thing changing at a time affects the outcome. For instance, you might ask, if we sell 10% less, what will happen to how much money we need? Be incorrect. Simulation analysis is like using a computer to create a range of possible results by changing different things around, like in Monte Carlo simulations. What's different? It's more about figuring out how risky things are in numbers, instead of just imagining different situations. For instance, you could run 10,000 simulations to see how likely it is that you'll run out of money when things aren't going as planned. Question 6. Financial ratio analysis. Financial ratios on their own are least adequate for evaluating a company's A. Historical profitability trends, B. Long-term ability to repay debt, C. Short-term liquidity position. Correct answer, B. Ratios don't tell the whole story about whether a company is creditworthy or can survive in the long run. Solvency ratios, like debt to equity and coverage, only give us a piece of the puzzle. To really understand a company, we need to look at everything: how it runs, who's in charge, what's happening in its industry, and what's going on in the economy. Even though financial ratios can help us figure out how much a company might grow and what risks it faces, they can't be used by themselves to figure out how much a company is worth, what its stocks are worth, or if it's a good bet to lend money to. A. Incorrect. Ratios are a great way to see how well a company has been doing in the past, like how its margins have changed over time. C. Incorrect. Ratios give us a snapshot of how liquid a company is right now, focusing on its short-term assets, current quick ratio. Question 5. Cross-sectional, trend analysis, and relationships in financial statements. An analyst is comparing the debt-to-equity ratios of 3 companies in the automotive industry for the fiscal year ended December 31st, 2024. This type of comparison is best described as trend analysis, B. Common size analysis, C. Cross-sectional analysis. Correct answer, C. When we look at how much debt a company has compared to its equity, like checking the debt-to-equity ratios of 3 automotive companies at the same time, we're doing a cross-sectional analysis. Cross-sectional analysis is like taking a snapshot of a specific metric, here, the debt-to-equity ratio, for one company and seeing how it stacks up against another company or group of companies. This comparison happens at the same moment or over a similar period. Sometimes we call this relative analysis. Analysts often use this method to see how a company stacks up against others in its field. They might look at its financial ratios and see how they compare to what's typical in the industry or just a few of its competitors. Ratios like the debt-to-equity ratio are especially handy for looking at companies from different sizes. They help take size out of the equation, so you can really compare companies that might be quite different in size. The debt-to-equity ratio itself is a way to check how well a company can pay back its debts. A higher ratio means the company has more debt compared to what it owns, which can be a sign that it might not be as stable. Different from other methods. A. Incorrect. Trend analysis compares a company's measures over time, like debt-to-equity ratios from 2022 to 2024. B. Incorrect. Common size statements standardize financial data by expressing it in relation to a single base item, facilitating comparisons and analysis. Question 4. Common ratio categories, interpretation, and context. Which of the following ratios is most likely classified as a measure of a company's operational efficiency? A. Current ratio. B. Fixed asset turnover. C. Debt-to-equity ratio. Correct answer, B. Fixed asset turnover is considered an activity ratio. Activity ratios are also called asset utilization ratios or operating efficiency ratios. These ratios help us understand how well a company is using its assets, like how effectively it's turning those investments into revenue. Usually, a higher fixed asset turnover ratio means the company is using its fixed assets better to make money. A. Incorrect. Current ratio is a liquidity ratio measuring a company's ability to meet short-term obligations. C. Incorrect. Debt-to-equity ratio, a solvency ratio, measures a company's ability to meet long-term obligations. Three crucial questions. Question 3. A company records a significant, non-recurring impairment charge on its property, plant, and equipment. All else being equal, this accounting event will most likely result in a higher return on assets in the current period, B. Lower net profit margin in the current period, C. Lower financial leverage ratio in the current period. Correct answer, B. When we have an impairment charge on property, plant, and equipment, it means we're taking a hit to the book value of these assets. This charge shows up as an expense on the income statement. This expense will directly lower our net income for the current period, assuming everything else stays the same. A lower net income means we're also seeing a smaller net profit margin, since that's just net income divided by revenue. Our return on assets might go down, not up, because the impairment affects both net income and the asset base. But since the immediate impact is on net income, that's what pulls ROA lower. The financial leverage ratio, usually calculated as total assets divided by equity, wouldn't drop immediately because of an impairment charge. In fact, if asset values decrease while equity also decreases, the leverage might even go up, especially if the equity decline is greater than the asset decline. A. Incorrect. Impairment charges decrease net income and total assets, potentially lowering ROA due to the larger impact of reduced net income. B. Incorrect. Impairment charges decrease both total assets and equity, generally leaving the financial leverage ratio unaffected or slightly increased. Question 2. An analyst collects the following year-end financial data in CAD millions for a company. Cash and marketable securities, 35. Accounts receivable, 85. Inventory, 120. Total non-current assets, 440. Total equity, 225. Quick ratio, 1.5. The company's financial leverage is closest to A. 2.4, B. 2.7, C. 3.0. Correct answer, C. To find the quick ratio, we add up cash and marketable securities and accounts receivable, then divide by current liabilities. 1.5 equals 35 plus 85 divided by current liabilities. So, current liabilities are 80. Next, we calculate total assets by adding current assets and non-current assets. Current assets equals cash plus accounts receivable plus inventory equals 35 plus 85 plus 120 equals 240. Total assets equals 240 plus 440 equals 680. Financial leverage is usually calculated as total assets divided by total equity. Financial leverage equals 680 divided by 225 equals 3.02. Question 1. When performing a financial analysis using only a company's most recent balance sheet, an analyst would be able to compute which of the following ratios? A. Debt to equity ratio. B. Gross profit margin. C. Fixed charge coverage ratio. Correct answer: A. Financial ratios are usually grouped into categories like activity, liquidity, solvency, and profitability. The debt to equity ratio is a key solvency ratio. Solvency ratios help us understand how well a company can handle its long-term commitments. This ratio compares the amount of debt a company has to the amount of equity it owns. The debt to equity ratio is simply the total debt divided by the total shareholders' equity. Both the total debt, which includes all your interest-bearing short-term and long-term debts, and the total shareholders' equity are all found on the balance sheet. If a ratio only uses numbers from the balance sheet for both the top and bottom, you don't usually need to average them out, since both numbers are based on the same date. Be incorrect. Gross profit margin, a return on sales ratio, is calculated by dividing gross profit by revenue, both found on the income statement. C. Incorrect. Fixed charge coverage ratio, a solvency ratio, measures the ability to cover interest in fixed charges. It is calculated as EBIT plus lease payments, interest payments plus lease payments.